Hey, thanks for joining me. This is going to be a video covering the US and the European stock markets. I've already recorded videos for the commodities, gold, silver, oil, and we've looked at the yen pairs and the dollar pairs. So if you haven't seen those videos, please go and have a look at them. And we'll now look at the E-mini S&P. So this is the E-mini S&P chart. Let's just scrunch it up to the beginning of the year. We are clearly in a bear trend. Clearly in a bear trend. Now, I'm quite surprised actually. Look. Well, this is the June low, I do believe. Yeah, June low. So the June low got to 36.39. We're actually trading above there now, would you believe? Now, to me, the economic outlook has deteriorated. Interest rates have kept going up. Bond yields have kept climbing. The dollar's climbed significantly since then too. So I'm really quite surprised that the stock markets are holding up so well. We are in a bear trend. Actually, look, let's have a look. This was Wednesday. This was the Fed announcement, right, of the rate hike, 0.75% interest rate hike. So we'd managed to recover. Well, this I decided was an inverse head and shoulders pattern. And once we broke above the neckline, it was my buy signal. Now, if you followed that, it was difficult because midweek the market came back down to retest the trend line, didn't quite get to it, but eventually we pushed higher with this big blue candle and hit the 100-day moving average at 39.00, 39.10. I think I had 39.10, 39.20 as my sell area. We didn't quite get there. We missed it by 2 points. I think we tried again on this and move up. Why is that saying 37.28? Oh no, sorry. We got to 39.24, so we did hit that resistance area and then we retested it just before the rate announcement. So 100-day moving average definitely doing its job as resistance. This was a really tricky day. Initially on the rate hike, the market thought that it was almost a soft pivot. It wasn't. Well, Powell certainly killed those ideas in his speech and the market turned around and tumbled. Tough day. If you were short, then you would have got stopped out initially on that move higher, I would have thought. And if you were long, you certainly got stopped out when the market collapsed and then went down further on Thursday. Then we saw a recovery on Friday. Why did we see a recovery on Friday? No idea. The unemployment number came out fairly strong, 261,000, I think it was. Jobs were created. Yes, the unemployment rate fell by 0.2%, but I think average earnings were up, if I remember correctly. Anyway, the market took that as positive. I think there are still some short positions in here that need to be squeezed out. Why are we still trading above the June low? Doesn't make any sense to me. Probably doesn't make any sense to you because people that are contacting me saying why the stock market's holding up, why they're not crashing, which probably tells me that everyone's short waiting for the dump, and that's why it won't happen yet. However, the charts are still pretty negative. Even in this last sort of section for the last 3 months, we're in a bear trend. This bounce only managed to retrace 50% of the move down from, what's this, the August high, I think, yeah. The August high down to the October low. We've managed to bounce 50%. After that little inverse head and shoulders pattern, the 100-day moving average was pretty much bang on the 50% line, so that lent some extra weight to that resistance level. We then formed what I think is probably a bear flag, this little upward correction counter trend move, which was very volatile and difficult to trade. And then with the interest rate increase, we not only broke below the trend line, the lower trend line here of what is probably the bear flag, this trend line here also, which had worked because on the way up we stalled there, and didn't we? We had a correction before we managed to break higher. But we're back below there, and we're also back below the 50-day moving average. Of course, we've rejected the 100-day moving average. So to me, it all looks pretty negative. Now, this unexpected bounce is reaching, or we hit or held resistance around 38.10, 38.20. So that's from the trend line, the 50-day moving average, and this confluence of fibs that we've got here, which also match the first swing high in October. 38.20. So that's definitely going to be the resistance level of the day on Monday on the open. Now, if we break higher, yes, we could get up and retest 39.00, 39.20. Why we would get there from a fundamental perspective, I've absolutely no idea, but I stick to technicals. You know, you never know what's going to happen. Break below last week's low, 37.04. That should create further downside. Just held on to this little trend line here. I don't know how relevant that trend line is actually. I'll leave it on because it did seem to hold the downside yesterday, but I don't think it's particularly strong. Stochastics on at the bottom of the page for the daily chart. There we go. You can see we got overbought just as we tested that 100-day moving average, and you don't stay in overbought territory for long when you're in a bear trend. When you're in a bull trend, you can stay overbought for a much longer period of time. But so that would have been a clue to the fact that you needed to be looking out for the market to turn lower. Now, we haven't got into oversold territory yet. We probably should do because we are in a bear trend. But anyway, we're getting a bounce back now. What else can I say? That's about it at the moment. There isn't really a lot more information on the weekly chart. Let me just check the weekly candle. Can I call it a bearish engulfing candle? The previous high was 39.24. Last week's high was 39.28. So yes, we didn't close below the candle, but we certainly engulfed it in so far as the wick. But I would have needed to see a close below 37.36 for me to be particularly bearish. But look, you can see we're in a short-term bear trend. 200-week moving average held on a closing basis at least, so that was good support. I still favour a move to the downside, but it's going to be choppy, and it's difficult to hold a short position, to be fair, even though we are in a bear trend. Stocks have got walloped a lot more than the S&P 500 stocks have got walloped, and we're now below the 200-week moving average, which of course we are not. We're above it on the E-mini S&P. Not a bearish engulfing candle, but still a big red candle. This bear trend is steeper, isn't it? It's just so well, we know that the tech stocks have been hit harder, and so they should be, because they certainly were in a bubble. We've got oversold on the weekly chart. Not going to pay too much attention to that. Whoops, where are we? Okay. Yeah, we're now, we're certainly trading below the June low. Is that the June low? That is the June low. So we're trading below the June low for the Nasdaq, which indicates that it's weaker than the S&P. It'll be fun to look at the Dow Jones in a minute, because that's a complete contrast. So this looks weaker. We didn't manage even to get to the 100-day moving average. We didn't even manage to get to this trend line. That's not even much of a bear flag. We didn't do the counter trend move. Okay, I guess I can call that a bear flag, but it was certainly not as pronounced as the one in the S&P. So the Nasdaq weaker overall. I guess that means if you want to be short, that's the one to be short. That's the one you're going to get the most performance out of. Choppy here though, and I just can't really comment on that. It's just choppiness from fundamentals, from the interest rate rise, a small recovery on Friday, again in line with the S&P for reasons which I don't really understand, but I think pressure remains to the downside. Now this stochastic did revert, this didn't stay up in overbought territory for long, which is the way it should be in a bear trend, heading into oversold territory now, but of course we can stay oversold for a long period of time. Look at that, we were oversold for certainly a month there with that quick bounce. So just because we're oversold, that certainly wouldn't indicate that the market will stabilize or go up. Look, the outlook is negative, but we're going to chop around, and obviously I'll put the levels on the sheets each day. Jones has looked stronger, the stronger of the three for quite a while. What a bounce back here. Double bottom, nice bullish candles. Look, bullish engulfing candle, huge bullish engulfing candle on the second leg. So, as you know, I expected the Dow to bounce, and it sure did bounce. Broke the neckline and overachieved the target. So that, on a technical level, that all worked quite well. Big green candles straight through the 100-day moving average. Didn't even pause on whatever day that was, 24th of December. On the next day, on the 25th, we then used the 100-day moving average as support to rocket again, and straight up through the 200-day moving average. It was the 500-day moving average that just proved to be too much for the Dow Jones on the bounce. But look, retraced 78.6% of that big collapse from August down to the double bottom in October. And 78.6%, we recovered so much, 80% nearly, as we tested the 500-day moving average. Really so choppy. If I told you in January that the Dow Jones was going to collapse, interest rates were going to go up, the economy was going to head for a recession, house prices were going to crash, bond yields were going to go through the roof, and I told you, sell it because we're going to go down significantly, it would have been really difficult to run a short position. The bounce is back, and this is always the case in a bear trend. The bounces are brutal because the bulls don't just give up. They're ready to buy. They still think that buying on the dip is the right policy. It hasn't been the right policy because, of course, we have trended lower. But wow, we have had some big moves to the upside. So we remain in a bear trend because the troughs and the peaks are consistently lower. So this trough in October was lower than the June low. This bounce, even though it was 78.6% or 80% of the August to October drop, it still is lower, of course, than the October peak, than the August peak, and we did hold the 500-day moving average. So pressure to the downside, but running a short position in the Dow Jones is not easy. You really have to time your trades. A big bounce back again on Friday, which I really wouldn't have expected on that strong unemployment number indicating that the economy is not as weak as it should be after such strong interest rate rises, and the Fed's going to have to do a lot more to weaken it. You know, if we've got unemployment is still growing, that's not really what you want if you're trying to stamp on inflation, is it? People still earning money, still getting jobs, and average earnings went up as well. Okay, that's all I can say. I will do the levels day to day. I'm not going to go into detail on the hour-to-hour levels and trade ideas for Monday, but I think we'll trend lower in the Dow Jones, especially because the S&P and the Nasdaq seem to indicate that will be the case. But if you want to be long, it looks like the Dow Jones is the one to be long, because that certainly does have these really strong bounces, and the Nasdaq probably is the one to be short because it looks weaker. I'm going to have a quick look at the DAX before I finish. The German economy looks in an even worse state than the US, but the fundamentals are not being reflected in the technicals. A really good bounce for the DAX rather. Recovered 38.2% of the whole move down, excuse me, from the beginning of January. That's pretty good. You know, nearly a 40% recovery in what I believe is, well, everything I read about the German economy is that it's going to deteriorate massively. Of course, they've got energy supply issues and all the stuff that I'm sure you already know if you follow the financial news. Things that the US economy doesn't have, and that's in bad enough shape with higher interest rates. Anyway, ECB have indicated that they are going to continue to raise interest rates. Lagarde, or whatever her name is, has said that basically they're going to have to crush the European economy to kill inflation, even though she can't understand where inflation has come from. Head of the European Central Bank doesn't understand that printing money creates inflation. Well, there you go. What hope have we got when people like that are running the financial system? Okay, so 13,500, 13,600 proving to be a good resistance level. Well, it should prove to be a good resistance level. It was on Friday. We got to 13,564, bang in the middle of my resistance. Why is it a resistance level? Well, it's the October peak. It's this confluence of Fibonacci levels. It's the 200-day moving average. Those three factors are a good enough reason for me to believe it's a strong resistance level, and it did hold despite this big green candle. We are overbought on the daily stochastic, which means we should turn lower sooner rather than later because we are in a bear trend. That's about all I can say, really. That's going to be your level for the week. If we break above 13,700, then that's going to look quite bullish in the short term, and I guess we can get up to this August high around 13,950, 13,970, but I favour a move to the downside. All right, that's it for my stock market analysis this week. I hope that helped. Got any comments? Got your own views? Put them in the comments box. I do tend to reply pretty quickly. I'm going to put some analysis in there as well, so make sure you read it, and I'll put in an offer for you if you're interested in the services that I provide. Thanks very much. We'll talk again next week.